Carbon tax, credits, and offsetting. Understanding the basics of carbon pricing. Presentation overview. Introduction to carbon tax. This section will provide a brief introduction to carbon tax and its purpose. We'll discuss how carbon tax works and its implications on the environment and economy. Carbon credits and offsetting. This section will explain the concepts of carbon credits and offsetting. We'll discuss how these two concepts work and their role in mitigating carbon emissions and climate change. Pros and cons of carbon taxation. The section will provide a balanced view of the subject by discussing the pros and cons of carbon taxation. We'll discuss the benefits and drawbacks of carbon taxation and its impact on businesses and society. Understanding carbon tax. Greenhouse gas emissions. Carbon tax is a tax levied on greenhouse gas emissions that helps reduce global warming and its effects on the planet. Switching to cleaner energy sources. The purpose of carbon taxation is to incentivize businesses and individuals to switch to cleaner renewable energy sources, reducing dependence on fossil fuels and carbon emissions. Carbon tax mechanism. Carbon taxation works by increasing the cost of fossil fuel usage, incentivizing businesses and individuals to switch to cleaner renewable energy sources. Carbon tax definition and mechanism. Definition of carbon tax. Carbon tax is a tax on greenhouse gas emissions that applies to fossil fuels such as coal, oil, and gas, making them more expensive and incentivizing the use of cleaner energy sources. Mechanism of carbon taxation. The mechanism of carbon taxation is relatively simple. It involves setting a price on carbon emissions and allowing the market to determine the most efficient way to reduce those emissions. Impact of carbon tax, reducing carbon emissions. Carbon taxation provides economic incentives to encourage businesses and individuals to switch to cleaner renewable energy sources, which can help reduce carbon emissions and mitigate climate change. Higher costs. Carbon taxation can result in higher costs for businesses and individuals, which may affect the economy. However, these costs can be offset by revenue generated from the tax, which can be used to support clean energy and mitigate climate change. Carbon credits. What are carbon credits? Carbon credits are tradable certificates that represent the right to emit 1 ton of carbon dioxide or equivalent gases into the atmosphere. They are a market-based mechanism to reduce greenhouse gas emissions. How do carbon credits work? Companies that emit greenhouse gases can purchase carbon credits from other companies that have reduced their carbon emissions. This creates a market for carbon credits and provides an incentive for companies to reduce their carbon footprint. Carbon credits, definition and mechanism. Carbon credits are a mechanism that allow companies to offset their greenhouse gas emissions by purchasing credits from companies that have reduced their carbon emissions. The mechanism of carbon credits is complex, but it can be used to incentivize companies to reduce their carbon emissions. Impact of carbon credits. Incentivizing carbon emissions reduction. Carbon credits can incentivize companies to reduce their carbon emissions, providing them with a financial incentive to do so. Purchasing carbon credits versus reducing carbon emissions. Companies may choose to purchase carbon credits instead of reducing their carbon emissions, which can undermine the effectiveness of the carbon credit system. Outsourcing carbon emissions. Carbon credits may lead to companies in developed countries outsourcing carbon emissions to developing countries in order to take advantage of cheaper carbon credits, which can result in the transfer of carbon emissions rather than a reduction. Carbon offsetting. Carbon offsetting is a practice that allows individuals or organizations to compensate for their carbon emissions by investing in projects that reduce or eliminate greenhouse gas emissions, such as planting trees, investing in renewable energy projects, or funding energy efficient projects. Carbon offsetting definition and mechanism. Carbon offsetting definition. Carbon offsetting allows individuals and businesses to invest in projects that reduce or eliminate greenhouse gas emissions to offset their own carbon footprint. Carbon offsetting mechanism. The mechanism of carbon offsetting is relatively simple. Individuals or businesses invest in projects that reduce or eliminate greenhouse gas emissions, such as planting trees, and receive carbon credits in return. Impact of carbon offsetting. Carbon offsetting provides an avenue for individuals and businesses to reduce their carbon emissions and compensate for their carbon footprint. It allows them to support projects that reduce carbon dioxide emissions or absorb carbon from the atmosphere. False sense of absolution. Carbon offsetting can result in a false sense of absolution where individuals and businesses continue to emit greenhouse gases. It is important that carbon offsetting is used as part of a comprehensive strategy to reduce carbon emissions rather than as a substitute for it. Pros and cons of carbon taxation. Pros of carbon taxation. Carbon taxation can promote cleaner energy alternatives, reduce greenhouse gas emissions, and encourage sustainable practices from both individuals and businesses. Cons of carbon taxation. Carbon taxation can increase the cost of goods and services, negatively impacting lower income individuals and small businesses. It may also incentivize companies to move their operations to countries with lower carbon taxes. Pros of carbon taxation incentivize carbon reduction. Carbon taxation incentivizes businesses and individuals to reduce their carbon emissions and promote the use of renewable energy sources, creating a positive impact on the environment. Generate revenue for climate initiatives. Carbon taxation generates revenue for the government that can be used to fund climate initiatives such as research and development of new renewable energy technologies. Cons of carbon taxation, higher costs. Carbon taxation can result in higher costs for businesses and individuals, which can affect the economy negatively. Job losses. Carbon taxation may lead to job losses in certain industries, particularly ones that rely heavily on fossil fuels. Ineffective and short term. Carbon taxation may not be effective in reducing carbon emissions in the short term. It takes time for businesses and individuals to adjust their behavior and switch to cleaner forms of energy. Conclusion. Carbon taxation, credits, and offsetting are complex tools that can have significant impacts on the economy and the environment. They can be used as tools to incentivize businesses and individuals to reduce their carbon emissions, but it is important to consider the pros and cons of such measures before implementing them. Thank you.